Foreign ownership of Chinese internet companies may still be unresolved territories, but venture capitalists and private equity investors remain confident that the ownership structure remains solid. BON's Katie Fisher has more.
Reaching China's 500 million internet users has proved challenging for foreign internet companies like Facebook, Google, and eBay. But thriving internet giants like Baidu, Sina, and a slew of other internet companies that are considered Chinese are relying on something else from abroad: money. In straight legal terms, foreigners are not allowed to own businesses in a group of regulated sectors, including the internet. But to skirt the national restrictions, Chinese companies have been using a corporate structural strategy to allow foreigners to indirectly invest in their companies. These variable interest entities, or VIEs as they're called, are a complex series of contracts to, in essence, give foreign entities listed offshore ownership without stock shares. It's a gray area, but VIEs have driven the growth of the internet sector in China for the past decade, generally without regulation from the authorities. The structure has begun to expand into other regulated sectors as well. But managing risk has increasingly become a point of concern amongst foreign investors, as there's been heightened scrutiny over VIEs. Bloomberg reports the U.S. Security and Exchange Commission is raising questions over the structure. And last month, the Chinese government indicated it may create new rules for VIEs. This on the heels of a series of fraud cases of Chinese companies listed in the U.S. and other examples of abuse. Lawyers generally advise new businesses to avoid the VIE structure for the sake of unclear legal restrictions. But investors persist. As venture capitalists met in Beijing last week, the general conclusion was the VIE structure is sound. Jay Chen, the CEO for China Venture, an investment advisory firm, says the investment environment in China is different from the U.S. If you want to cash in on the China market, there's risk involved. But he says because VIEs are holding up some of China's most successful businesses, he doesn't expect China to clamp down because it would inflict too big of a blow.
It was actually a very big concern, especially for USD-denominated funds, and a lot of the venture capitalists were talking about it, right? But at the end of the day, people were like, okay, we still got to do what we got to do, right? If we like the company, we still got to make the investments. If the Chinese government, one day says that the VIE companies cannot go public in the U.S., so not just us, but all USD-denominated funds will be screwed. Because people are betting that the Chinese government, they will not do something like that. I mean, they were not really doing that for the past 10, 12 years.
Guo Jia, general partner at Ventec Capital, remains confident that their investments are secure.
For VIE, this structure is the compromise to the very out-of-the-date regulation in China, especially for the 11 industries. They banned the foreign investment to go in. But according to the WTO agreement and according to the open attitude of the government in China and the Chinese environment, so maybe not necessary always use VIE, but for the existing VIE structure, I believe the Chinese government has some proper attitude to protect every party's interest in the VIE structure, including the entrepreneur, including the common shareholder, including the foreign investor as well.
For now, it's investor confidence that will keep this structure intact, but analysts expect more scrutiny in the future. Katie Fisher, BON.